Generally speaking, do you believe that history tends to repeat itself more often than not? If you're like most people, you probably answered yes. Have you ever asked yourself, what kind of return on investment is the stock market said to yield over the long term, such as 100 years? The answer is usually around 8 to 10%, so let's split the difference and say it's 9%. How that works is, over the very long run, 6 to 7% comes from growth, and 2 to 3% comes from dividends. What if that 6 to 7% growth came in clumps over a long period of time? And what if, historically, there were huge periods of time where the market yielded zero growth and huge periods of time when the market yielded double-digit growth? If these periods alternated throughout history in a very predictable and repeatable fashion, as an investor, would you want to have access to this information? Let's look at what history shows us going back to the beginning of the 20th century, from say 1899 to 1921. You would see during that period that there were lots of good years and lots of bad years. But the good years and bad years all washed each other out, resulting in zero growth. Then, from 1921 to 1929, the Roaring Twenties, we had a great period. It was actually a very exciting time in our country. But if you remember from your history books what happened in 1929, the market crashed. And from 1929 to 1954, we had another period in the market that resulted in zero growth. Then from 1954 to 1966, the markets did well again. Some of you might remember that period as when America was on top of its game. Then in 1966, we went into another bear market, one of the shortest in U.S. history from 1966 to 1982. And again, the good years and bad years all washed each other out, resulting in zero growth. Then, of course, in 1982, the rest is history. The stock market took off after 1982, and between 1982 and 2000, we had the best bull market run in U.S. history. Unfortunately, as predicted, that all turned around in the year 2000, and of course, the last 17 years have not been so good. So, according to history, roughly how long is the average bear market? If you said 20 years or so, you would be correct. Throughout history, we've consistently had 20 years or so of bear markets, followed by shorter bull markets, followed by more bear markets, and so on and so forth. In 2013, the stock market finally broke through its ceiling that had existed since the year 2000. Normally, that would imply that we've exited the secular bear market cycle and entered into a new secular bull market. However, many experts question that, as they point to the unprecedented level of artificial stimulation that caused it. So, is it possible that this is the first time in nearly 200 years of history that the stock market recovers after only 13 years? Well, of course, anything is possible. However, what you're asking yourself right now is it probable? According to market history, clearly, the answer is no. It's also worth mentioning that every secular bear market we've seen in history has had 3 or more major drops. Again, how many have we had since the turn of the century? Only 2. So the big question then becomes, when will the third drop happen, and how precipitous will it be? So we've never exited a secular bear market in less than 13 years. We've never seen a secular bear market end with less than 3 major drops, and we've only seen 2 major drops thus far. If the analysts are right, and we're entering into a new secular bull market, that means we're currently poised to break 2 Guinness Book of World Records at the same time. Fortunately, there's one last piece of information to be mined from stock market history to let us know if we are in fact truly poised for a permanent recovery, and that's looking at the price-to-earnings ratio of the stock market. If a company's stock was currently trading on the open market, the PE ratio would simply be the price of all outstanding stock divided by corporate earnings. It stands to reason then that the stock market as a whole has a PE ratio as well. And historically, when we're about to end a secular bull market cycle, like we did in 1999, PE ratios end up in the upper 20s or higher. However, we've never recovered from a secular bear market cycle until PE ratios are in the single digits. Where are they now? Somewhere between the upper teens and the lower 20s. So, with the probability of breaking 3 Guinness Book of World Records being highly unlikely, and with there being so much conflicting information about stock market cycles in general, Baby boomers realize that the onus is on them. Now more than ever before, they must educate themselves and seek advice from financial professionals that are dedicated to helping individuals and families meet their immediate and long-term financial objectives, not some top-down corporate mandate or quota. Call us today or visit our website to schedule a free consultation with one of our advisors.